And so obviously there's not a kind of one size fits all, which I think previously people had kind of fallen victim to. When that shift occurs, which really is kind of already underway, what is the impact on the market side, right? So where do you see that capital going? If that 60 goes to 75, 90, even 100, where does the capital go? And then kind of how do you see that changing the market dynamics as well?
Yeah, so a couple things there. First, if we look at sort of the AUM of hedge funds, VC firms, and PE firms over that time period, they've clearly been the biggest beneficiaries. So back in 1976, there was less than $1 billion allocated to hedge funds in total. In 96, that was 130 billion. Today, that's $1 trillion. Right. So those are really public market and some public credit investment opportunities for the most part. In 1976, there was less than $4 billion in venture capital funding. In 96, it was 39 billion. Today, that's approaching 500 billion, right? So that starts to matriculate itself in the private markets. And then, probably most impressively for PE firms, there's less than $1 billion in 76. In 96, there's 160 billion. And today, that's 1.5 trillion. And they had two tailwinds, right? Lower interest rates make LBOs a lot more attractive. But they also had the, genesis of the high yield bond market by, Milken and all the folks over at Drexel. So you kind of had the birth of an asset class concurrent with this massive capital allocation shift. So you're seeing people go into private equity, you're seeing people go into venture, and you're seeing people go into public markets. And what becomes interesting is at the same time that you have these assets flowing into the public markets, the number of public companies have been cut in half, right? So from 1996 to today, you have half the number of publicly traded companies that you do. We're just at 3/4 of where we were in 1974. So you have greater assets chasing less and less opportunities. There was a really good academic paper published called the U.S. Listing Gap by folks out of, I believe, Cornell and Ohio State. And they showed that back in 76, the market cap of U.S. stocks was 3.3 trillion, which was, 49% of GDP. And today it's 38 trillion, which is 176% of GDP, right? The average market cap of a company was 650 million bucks back then. And today it's $10 billion. So, when you think about that, it naturally leads to price appreciation because there's only so many places you can allocate that capital.
Got it. And so obviously, not only are we seeing kind of this movement of capital, but this is all happening simultaneous to a pandemic, an economic recession, kind of all of the macro shifts that we've seen. How does the kind of catalyst for all of this and then the reaction of lower interest rates and a bunch of quantitative easing, how did that kind of perfect storm of events change or accelerate kind of this shift?
Sure, absolutely. So, what I've said historically is QE infinity kind of pushed people out the risk curve, right? So it changed your savings account into your checking account, the bond market into the savings account, the equity market to the bond market, the venture market into the equity market, and it gave rise to the crypto market as a new venture market. Right. And you're kind of seeing that happen. So, in the 30 years before the global financial crisis, the Fed's balance sheet expanded by $700 billion. That took 10 days in March. Right. We've injected $7 trillion of liquidity into the system year to date, with another $1 trillion to 2 on the way, which is crazy when your bid ask is now $1 trillion. But it's not just the Fed, right? So cumulative central bank balance sheets have exploded. So from 2000 to 2008, the balance sheets of the Fed, the BOJ, the Swiss National Bank, the BOE, and the ECB went from $2 to $4 trillion. Then post-crisis, it went from 4 to 10. This year alone, we've gone from 16 to 22. So basically 8 months, we saw as much cumulative central bank balance sheet expansion as we did 7 years post not only the global financial crisis, but the Euro crisis as well. And 3 times as much during the decade prior to, but post the dot-com crash, right? So you've seen this insane amount of liquidity that's entered the market. And I think, in March, it was really a seminal moment where we crossed the Rubicon where no one asked, how do we pay for this anymore? Right. The fact that the Democrats and the Republicans right now are arguing over $2 trillion is asinine if you think about where we were, 10 years ago. And I think that's really the big difference today versus, our father's QE generation, right? Where a lot of people said, oh, inflation's going to come, but it never really materialized. And I think you had a completely different macro backdrop then versus now, right? So prior to the global financial crisis, banks had zero excess reserves. They were right against their limits. So when the Fed started to expand its balance sheet, that went into the excess reserves that the banks had to hold. It never really materialized in M1 and M2. This year, you have money going directly into checking accounts with the stimulus check. It looks like we're going to have another one on the way before the election. You have federal unemployment benefits topping people up at greater than the median salary in this country. You have money going directly to companies with PPP and EIDL. You have the Fed literally backstopping corporate bond purchases. So you're actually seeing a significant increase in M2. So, the Fed publishes all this data. If you look at Fed charts, you can look at a chart of M2 throughout the totality of the global financial crisis. It's grown in a linear fashion up until this year, where it's up, $3 trillion year to date. To put that in perspective, it took 7 years to expand by $3 trillion. That just happened in 4 months. So in June, which is the last metric we have, M2 is up 25% year over year. That's the highest reading all time. The last time it increased anywhere remotely close to this pace was during World War II. So you think about the inflationary pressures that we have right now, where does money go? I know you've spoken about this letter a lot on this podcast. Paul Tudor Jones talks about backing the fastest horse in this race. And he highlighted, NASDAQ 100 stocks, Bitcoin and gold. And, he pointed to Bitcoin there. But I think you're seeing that materialize not only in the credit markets, which have gotten incredibly tight, therefore in the equity markets, which have rallied now back to all-time highs. And of course, in this long tail of, alternative assets, whether it be, gold, whether it be Bitcoin, or whether it be private markets.